Hello and welcome to AccountingSuite Academy. Today we're going to understand the three core financial statements used in business accounting: the income statement, the cash flow statement, and the balance sheet. Instead of explaining them separately, we'll walk through one simple business example. Imagine a company that buys a product and sells it later. We will track what happens across 4 months. We start with cash, then we purchase inventory. Next, we ship the product to a customer. And finally, we receive payment. At every step, we will see how the same business activity appears in all three financial statements. Investors invest $100,000 into the business. The company now has cash to start operations. We start with the income statement, which shows revenues and expenses for a period. In month 1, nothing happens yet. No revenue, no cost of goods sold, no operating expenses. So profit is 0. The key idea is that the income statement only records economic activity that affects profit. Right now, nothing has happened. Next is the cash flow statement, which tracks actual movements of cash. At the beginning of month 1, cash balance $100,000. During the month, no cash comes in and no cash goes out. So the closing cash balance remains $100,000. Finally, we look at the balance sheet, which shows the company's financial position at a point in time. Assets equal equity plus liabilities. Assets contain only cash. Cash equals $100,000. Liabilities are 0. Equity equals $100,000. The company simply holds cash. Nothing else has happened yet. Month 2. The company starts operating. It buys products that will later be sold to customers. We always begin with the income statement. In month 2, the company incurs operating expenses of $5,000. These represent typical business costs such as salaries, rent, utilities. There is still no revenue yet, so the income statement shows revenue 0 expenses, $5,000 net profit minus $5,000. The company records a loss for the month. Now we move to the cash flow statement. During month 2, two things happen. First, the company buys inventory for $20,000. Second, it pays operating expenses of $5,000. Inventory purchase $20,000. Operating expenses $5,000. Closing cash balance becomes $75,000. Now let's see how this affects the balance sheet. First, the loss of $5,000 reduces equity. Equity decreases from $100,000 to $95,000. Next, we look at assets. Originally, we had $100,000 in cash. After the transactions, cash decreases to $75,000. Inventory appears as a new asset. Inventory equals $20,000. Total assets equal $95,000. Equity. Capital and retained earnings equal $95,000. Notice something important. Assets didn't simply shrink. They changed structure. Part of the cash has turned into inventory. Now a customer buys the product. The sales price is $40,000. However, the customer will pay later. The company ships the product today. Payment will come next month. We begin again with the income statement. This month, the company records revenue of $40,000. But to calculate profit, we must also recognize the cost of goods sold. The inventory we purchased earlier cost $20,000. So the income statement shows revenue $40,000, cost of goods sold $20,000. This produces gross profit of $20,000. Next, we subtract the monthly operating expenses of $5,000. So the business made $15,000 profit this month. Now let's check the cash flow statement. This is where many people get confused. Even though we recorded $40,000 of revenue, no cash has been received yet. The customer has not paid. So the only cash movement is operating expenses. $5,000 leaves the company. Opening cash is $75,000. Closing cash becomes $70,000. This shows an important rule. Profit does not always mean cash. Revenue is recorded when the sale happens. Cash is recorded when payment arrives. This is a crucial accounting concept. Now we move to the balance sheet. First, the revenue we recorded appears as accounts receivable. This represents money owed by the customer. So under assets, we now have cash is $70,000, accounts receivable $40,000, inventory 0. Why is inventory now 0? Because the goods were sold and recognized as cost of goods sold on the income statement. They no longer exist as inventory. Total assets are therefore $70,000 plus $40,000 equals $110,000. Next, we look at equity. Previously, equity was $95,000. This month, we added $15,000 profit. So equity increases to $110,000. This shows another key principle. Profits increase equity. Now the final step. The customer pays the invoice. $40,000 arrive in the company bank account. In month 4, there is no new revenue. The sale was already recognized last month. The only activity is the monthly operating expense of $5,000. The income statement shows the following. Revenue is 0, expenses are $5,000. Net result is minus $5,000, and next we look at the cash flow statement. Two things happen. Cash inflow. Customer payment is $40,000, cash outflow. Operating expenses are $5,000. Net increase in cash is $35,000. Starting cash is $70,000. Closing cash becomes $105,000. Finally, we update the balance sheet. First, the accounts receivable disappears because the customer paid. So, accounts receivable goes from $40,000 to 0. Cash increases accordingly. But we also had $5,000 expenses, which reduce equity. So, the final balance sheet becomes, in assets, cash equal $105,000 in equity, capital plus retained earnings equal $105,000. Inventory and receivables are now 0. Across the 4 months, the results are the following. Revenue is $40,000. Cost of goods sold is $20,000. Gross profit is $20,000. Total operating expenses are $15,000. Final net profit is $5,000. The cash flow statement shows the actual movement of cash. Starting cash is $100,000. Cash increased to $105,000, so the company generated $5,000 of net cash over the 4 months. The balance sheet shows the financial position at a specific point in time. At the end of the period, cash equals $105,000. Shareholder equity equals $105,000. This simple example shows the key difference. Income statement measures performance. Cash flow statement tracks liquidity. Balance sheet shows financial position. And together they explain how a business turns inventory into profit and ultimately into cash. Financial reports are tools for understanding a business. Different people use them for different purposes. Investors use them to evaluate performance and growth. They want to know if the business creates profit and increases value. Managers use financial reports to make decisions. They monitor revenue, control costs, and manage cash. Finance teams use them to track operations and ensure accurate accounting. Banks and lenders analyze financial reports before giving loans. They check profitability and cash flow. Together, these reports explain the financial health of a business. We hope this example helped you better understand how the 3 financial statements work together. Don't forget to visit our website. Thank you for watching.